You know, when we talk about wealth, the conversation is almost always about one thing: how to get more. But what about actually keeping it? Today, we're breaking down a really fascinating strategy that suggests a total shift in thinking, moving from just growing your wealth to truly preserving it for the long haul, for generations. So, the source material we're digging into today frames the conventional path, stocks, hard assets, trusts, in a pretty provocative way. It says it's like parking your wealth in a casino. Sure, it's designed for growth, for stacking up more chips, but as we're about to see, it's got some serious, dangerous flaws when it comes to legacy and long-term preservation. So, what are these hidden flaws? Well, the first big problem isn't some sudden dramatic market crash. No. It's something much quieter. It's a gradual, almost invisible erosion of your assets that's happening every single year. And they have a name for this. They call it the slow bleed. Just imagine your nest egg as like this cracked urn. There are all these little forces constantly at work, making sure that your wealth is always leaking out bit by bit. So let's break down what's actually causing this leak. You've got your advisor fees, right? Then there are taxes on your income and your capital gains, which basically penalize you every time you make a successful move. And then there's the big one: inflation, the silent thief that just eats away at your buying power. Each one might feel like a tiny crack, but you put them all together and you've got a serious leak in your financial foundation. Okay, so that's the slow, quiet killer. But believe it or not, that's only half the story. The source points to a second, much more dramatic problem, and it happens the very moment a trust is triggered to pass that wealth on to your family. The moment that trust kicks in, bam, it's like a dinner bell rings. The source uses this really intense metaphor. It's like opening a cage, and a predictable, devastating chain of events begins as these so-called vultures arrive to pick at the very assets you spent your entire life building. So, what does this feeding frenzy actually look like? Well, first, you get hit with massive capital gains taxes as assets get sold off. On top of that, a whole army of professionals, lawyers, accountants, brokers, they all show up to take their cut. And finally, just handing out cash can spark resentment and greed, leading to incredibly costly legal battles between your heirs. At the end of the day, the inheritance gets shredded by the very system that was supposed to protect it. So when you hear all that, the slow bleed, the inheritance trap, it sounds pretty bleak, right? It naturally leads to the big question. And this is where things get really interesting. The document lays out a completely different path. It's not the chaotic, volatile road of the casino. It's something they call the fortress. The strategy is called the Real Estate Legacy Partnership, or RELP for short. So what is this RELP strategy? Well, the core idea is pretty brilliant. It's all about converting your paper wealth, the stuff in that volatile casino market, into tangible, income-producing assets that can build a real, lasting family legacy. Okay, so here's how it works, broken down into 4 steps. It's actually pretty straightforward. First, you shift your capital out of those volatile assets. That capital then moves into a protective, family-owned LLC that you're in complete control of. From there, the LLC invests in income-producing real estate. And the end result? A partnership that creates passive income and provides direct benefits for your family. A truly sustainable legacy. Okay, that's the how. But the real magic is in the way this structure actually protects your money. The secret sauce, according to the source, is a strategy built for what it calls radical tax efficiency. And the engine powering this whole tax shield is a specific tool called 100% bonus depreciation. Now, don't get bogged down in the jargon. All it really means is a massive, immediate tax deduction on certain assets. And this is the key to, as the source puts it, starving the vultures by getting rid of the major tax hits that let them feed in the first place. This tax fortress is basically built on 3 really strong pillars. First, that bonus depreciation can wipe out the taxes on the income you use to fund the partnership. Second, it keeps working year after year, offsetting the passive income the properties generate. And third, and this might be the most important part, there are no estate tax issues because your heirs already owned a piece of the LLC. The assets just pass on seamlessly. But here's where the strategy gets really compelling, because it's not just about the numbers, the taxes, or the legal structures. The source argues its true power is in changing what a legacy even is. It stops being a number in a bank account and becomes a real place for your family to share experiences. And this is exactly what they mean. You're not just getting a statement in the mail. You get immediate, exclusive access to a place like this one, the Sierra Ranch. It's positioned to be a family home base, a tangible place to make memories together, right now, not someday after you're gone. And this isn't some vacation home you have to stress over. These properties are fully managed and come loaded with amazing amenities: a pool, a private theater, even private access for things like ATVing and river rafting. The whole point is to make it a completely hands-off home base for your family to just enjoy. And get this, the experience isn't even limited to one location. The strategy has this incredible component for tax-free global travel, using partnerships to let you exchange time at your home base for stays at other luxury spots all around the world. So you're probably asking, how in the world does that work? Well, it's pretty clever. The passive income from the properties covers all the operating costs, so you're not paying anything out of pocket. Then you can essentially barter your time, trading a week at your home base for a week in Tuscany or the Swiss Alps. And because it's a non-cash exchange, these incredible global vacations end up being tax-free. It's the ultimate family perk. All right, so we've laid out two very, very different paths. You've got the traditional casino on one hand, and this alternative fortress on the other. Let's just put them right next to each other and see how they really stack up. This table just lays it all out, doesn't it? The traditional path, you've got the volatile market, the constant tax leakage, and the real potential for family disputes, all leading to a legacy of cash that just gets spent. But with the RELP strategy, you get tangible assets, a tax fortress, and shared experiences that bring everyone together, creating a lasting legacy of passive income and enjoyment that starts today. We'll leave you with this powerful quote from the source material, which I think just hits the nail on the head. It's a reminder that once you've already won the game of accumulation, maybe the goal shouldn't be about chasing another 10%. Maybe it's about protecting what you have and turning it into something truly meaningful, building a fortress for your family, not just a bigger pile of chips. The question is, which path is right for your legacy?